thank you for tuning in to our Retirement Education Center YouTube channel, where on this channel we believe in providing you unbiased advice that will help you maximize all of your retirement income. Now, on our channel, we do not believe in providing you any type of silver bullet strategy. And of course, we don't glorify any type of one product. But what we do believe in are holistic concepts that would help you retire with confidence. So today, what we're going to be asking are what are the 4 main retirement questions that end up confusing most retirees. Now, if you don't know what these questions are, then it's probably because you are confused as well. So if you want to know what these 4 questions are, we highly encourage you to stay locked in today. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea Graves, Director of Operations at the Retirement Education Center. And we want to thank you for tuning in to our Retirement Education Concepts videos. These videos were created to help to make the difficult and confusing retirement process simple.
Absolutely, Andrew, because with so many retirement concepts out there, so many retirement strategies, and of course, so many retirement products, it can become very difficult for consumers to digest it all. That is why we're so fortunate that we're able to work with a team of expert advisors to help us build a financial roadmap that will let our clients know when, where, and how they can reach their retirement goals.
For additional concepts on how to maximize your retirement, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos. Carson, there are so many issues when it comes to retirees when making decisions with their money. So how can advisors like you help them with this?
Well, Andrew, as you know, there's an old saying out there that I really don't appreciate sometimes.
What is
it? And it goes as, what you don't know can't hurt you. Now, I've heard that over the years, but I can tell you, when it comes to retirement planning, Andrea, what you don't know can really, really hurt you badly, especially when you're trying to reach your retirement goals. And I think it is incumbent upon financial advisors, Andrea, to not only help retirees understand the questions that they should be asking, but also providing them the proper answer as well. That's what you should be doing in order to help them fill that retirement gap. So what we're going to be doing today, we're going to be talking about 4 main questions that I believe, just from doing my classes when I teach, Andrea, 4 main questions that I believe confuse many retirees out there. But before we get into that, there are 2 rules to retirement income that we like to provide you. And what are those 2 rules, Andrea?
Well, rule number 1 is to never run out of money, and rule number 2 is to never forget rule number 1.
All right, so let's go ahead and talk about what may be confusing you and many other retirees out there.
Okay, Carson, the first thing that you've noted, and we've talked about this a lot, is inflation. So why would this be a confusing thing for retirees?
Yeah, inflation. I know we've talked about this a lot, Andrew, but inflation is a big deal. And many retirees do not understand the full effects of what inflation can do for their money. Now, imagine you're a 65-year-old person, right? You're retired and you're on a fixed income. Well, take a look at the screen of what a 3% inflation rate could actually do to that particular person. Look at the screen real quickly here, Andrea. So imagine today you have $100 coming in, if you look at the screen, and it's buying $100 worth of goods. Look at what happens in 20 years from now, Andrea. That same $100 will only be able to purchase $55 worth of goods. You have literally, cut your money in half in 20 years with just 3% inflation. So people really have to understand how to get a grip of this. There are 3 things that we help our clients understand in order to combat or mitigate the effects of inflation. 1, and we've talked about this numerous times, we have many videos on this, and that is maximizing your Social Security benefits. Anyone who's watching this video, you have to understand the importance of this, because Social Security actually have their own cost of living adjustment to actually increase along with inflation every single year. In 2022, those of us who were actually delaying our benefits or actually receiving Social Security would have received a 5.9% increase on those benefits. Now, hear this, Andrew. For 2023, due to the fact that we've been in such a highly inflationary environment, they are projecting that Social Security could have a cost of living adjustment of anywhere between 9 and even maybe 10%. this would be another historic increase in our benefits. So one of the things that we have to make sure of is that we maximize your Social Security. Secondly, you must, because income is an important issue for most retirees. If you risk the fact of running out of income due to the fact of inflation, you need to take a look at annuities. No matter what you think about annuities, it is the only vehicle that will guarantee that you will never run out of money, even if your account value goes to zero, Andrea. And Andrea, some annuities will even allow for that income to increase. Some will stay stagnant, just depends on what type you're getting. But there are some annuities that will also increase with market returns, and there are some annuities that will increase with inflation as well. You have to talk with your respective advisor about what benefits your annuity can provide for you. And lastly, what you need to make sure of is that you do not run from equities. We know that equities provide a strong fight against inflation, because over the last 92 years, it has actually outpaced inflation by 234 times. What other element is going to be able to do such a great job of fighting inflation other than equities? So according to your risk tolerance and of course your time horizon, you need to again speak with a qualified advisor who can help you implement the proper amount of equities that you may need to have in your portfolio in order to combat inflation as well.
Carson, next is something that I don't think many people have heard about at all, and that is the sequence of returns. What can you tell us about that?
Sequence of returns risk, right? And that is a very, very dangerous risk that is always lurking for retirees who are actually taking money out of their retirement savings. So one of the things that you have to know about sequence of returns risk is that it's mainly a timing issue. That's what it is. Now, what I need to do to really highlight how big of a danger this can be to retirees, Andrew, I want to put this on the screen. I want you to take a look at what sequence of returns risk could really do to a portfolio. Take a look at these two portfolios, Portfolio A and Portfolio B. Now, they actually have the exact same returns. It's a $500,000 portfolio, and as you can see, in year one, Portfolio A had a 33% return, and if you look at year 20, Portfolio B had a 33% return. Now, also, if you take a look at Investment B, you can see that in year one, it was down 28%, but in year 20, Portfolio A was down 28%. So they have the exact same returns, but the returns are just inverted. As you can clearly see, at the end of 20 years, those portfolios have actually accumulated to the exact same amount. So what does that tell you? Sequence of returns has no bearings when you're actually accumulating those assets. Now take a look on the right hand side of your screen. Here what you can see that we're taking $25,000 a year, and we're also going to be accounting for inflation of 3% in this scenario. The same exact returns, but take a look at year 20. In year 20, Portfolio A, after extracting $25,000 a year with inflation of 3%, still has a little over $1.4 million, almost $1.5 million remaining in order to continue to take resources from or even leave along as a legacy for their estate. Look at Portfolio B. Around year 18, literally, that person is out of income because why? They really are down to like $24,000. So they're really out of income in year 18, but they are completely in the negative in year 20. Completely in the negative. They have ran out of income. The exact same returns. So you can absolutely see from this example that sequence of returns must be an element of your portfolio that you discuss with your financial advisor.
Carson, thank you again for your insight on this topic, and thank you for watching. And if you felt this information was beneficial for you, please like this video and share with others.
So I really do hope that the information that we shared with you today gave you some insight on the 4 major questions that have been confusing many retirees. Please remember that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for a fiduciary financial advisor to help you with these types of complex financial matters, we highly encourage you to utilize the links in the description below and go ahead and schedule a 1-hour free consultation with us today.
For more information about this topic or any of the other topics that we've shared in our other videos, please feel free to reach out to our office or leave any questions or comments in the section below. After this video, please check out our other videos that we've created that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.